Hi, I'm Ankit from ValueNest and I specialize in research-led property investment strategies. I help property investors make confident, data-driven decisions by focusing on numbers and fundamentals and not the headlines. So today, I want to explain a term you will often hear in the property research circles, which is cheapies with prospects. So this isn't about buying the cheapest properties you can find, and it's definitely not about chasing distressed or low-quality assets. Cheapies are what we call the ugly ducklings of city real estate, markets which are misunderstood, overlooked, or temporarily out of favor but supported by strong fundamentals and future demand. In this video, I'll explain what cheapies really mean, why they matter heading into 2026, and how smart investors should interpret this data. So what does cheapies really mean? When research firms talk about cheapies, they are not talking about risk-free assets. They are talking about relative value. A cheapie is a market that looks affordable compared to its city or regional peers. It has solid rental demand and yield. It shows early signs of momentum before it becomes mainstream. These markets often feel uncomfortable at first. They might be in smaller capital cities, in unit markets instead of houses, or in locations investors previously ignored. So historically, many strong growth markets started their cycle as cheapies before sentiment caught up with reality. So what are the risks and why context matters here? It's important to be very clear, cheapies are not low risk by default. There is a lot of research that is required when selecting the right cheapies or right markets or cheaper markets to invest in. Some come with a high insurance cost, greater price volatility, or smaller market size as well. That's why selection matters a lot here. The research consistently stresses avoiding poor construction quality, compromised locations, high density investor towers, and properties with weak strata management. Now, cheapies does not mean being careless. The opportunity exists when price, demand, and quality align together. So that's where we focus most on. Now let's discuss where cheapies are showing up right now, heading into 2026. First one on our list is Darwin and Palmerston, especially the houses there. So let's start with Greater Darwin, especially the Palmerston corridor. So Darwin remains in the cheapies category because the entry prices are still modest for a capital city. Rental yields typically sit in the mid 6% range. Third is the tenant demand and is supported by defense, resources, and public sector jobs. However, this is a small and volatile market. The research clearly advises focusing on standard 3 or 4 bedroom houses, especially in the established suburbs, practical blocks near schools, shops, and employment nodes. For investors with a medium-term view and risk awareness, Darwin still offers one of the strongest yield plus upside combination in Australia's north. Second on our list is the city of Stirling in Perth, and we will be talking here about the unit market, not the houses. Houses in Perth have already had a strong run in the past few years, so the remaining value sits in low to mid-rise apartments, lifestyle-rich suburbs like Scarborough, Englewood, and Jundana, units which are close to rail, beaches, and employment centers. Unit medians here often start in the low 400s with yields around 5%. Very tight vacancy rates, and the support from a multi-billion-dollar city center redevelopment which is happening in Perth at the moment. So this is a classic example of relative affordability within a strong city cycle. Moving on to New South Wales, the third one in our list is Canterbury in Bankstown, Sydney. Again, we'll be talking about units here. So Canterbury Bankstown makes the list because it offers one of Sydney's most affordable entry points. Houses are no longer cheap here, but units still are. Now, when we talk about units, we'll be specifically talking about older brick walk-ups, mid-rise apartments only, something which is close to rails, shops, hospitals, and future metro upgrades. Yields typically sit between 5 and 5.5%, which is supported by constant tenant demand, a large, diverse local economy, and significant public investment. This is not a boom market. It is a steady demand, cash flow supported play within Australia's largest city. Now, the fourth in our list is Melbourne. We'll talk about Melbourne City and established units there. Melbourne units are back on the cheapies list for one of the key reasons, which is relative value. After years of underperformance, now the transaction levels are rising again, vacancy rates are tightening, and price momentum is improving. The focus here is very specific: larger established apartments in the inner and middle ring suburbs, avoiding small studios and high density investor towers. This is about buying quality assets at discounted prices and not just chasing the cheapest square meter sort of properties. Next one in our list is in southern Logan, Queensland. Again, we'll talk about units here. So Logan, southern Logan especially, located between Brisbane and the Gold Coast. This corridor remains affordable while it is benefiting from a huge population growth, a lot of infrastructure investments, and very tight rental conditions. The research preference here is for townhouses and low-rise units, which is close to rail and services. We need to be careful and avoid the flood-prone or the fringe locations here. This is very important. And now this is a classic growth corridor, Cheapie, where affordability and demand intersect. Now, what is the key takeaway? Cheapies are not about buying cheap property, so don't get confused here. They are about buying value early before the broader market recognizes it. And that's where the research leads you to. If it is used correctly, cheapies can improve your portfolio cash flow, can reduce your entry barriers, you can enter into the market even at the cheaper prices and position investors ahead of the next growth phase. If they are used poorly or not, research is not done properly, they can amplify the risk. That's why data, selectivity, and a medium-term strategy matters a lot. Every major growth cycle starts somewhere. Often it starts in markets people ignore, the so-called ugly ducklings. For investors who understand the risk, respect the data, and focus on quality, cheapies with prospects can become tomorrow's standout performers. And that's what we have seen in so many markets across Australia from multiple years. So if you would like help in interpreting which of these markets fits your strategy, feel free to reach out and start the conversation with us. Thank you for watching this video. We'll see you in the next one.